We're recording, I hope. Yeah, we're recording. Cool. So we have to train to think as a fundamentalist, and we are going to trade as a technician. And once we're able to understand the fundamentals behind the market, we will then, and only then, and if we apply the correct technical rules, we will be able to become successful. Once we understand the technicals, and understand the fundamental, and use the it is not a job of a trader to become an analyst. Some people find it fascinating that they can go in and look at the numbers and read the economic reports and read the balance sheets of the companies and stuff like that. It is not important to become an analyst. But we should not ignore by any means the economic reports, because these economic reports and political events can often move the markets. Fundamental analysis is more of an education for us. It is a way for us, it gives us the intellectual pursuit of knowledge. We're trying to find out what is happening in the market. And the data is being sifted. We go in and sift into the data. We can Google, we can search, we can find all the data so that we can define what is going to be the future direction of the prices. But keep in mind, and this is the biggest handicap when it comes to fundamental analysis. This is unfortunately the biggest drawdown. Two things. One is the lag time. The second is that this information, for most of the time, it is discretionary. So, if some news is going to be given out to the general public, a company is going to pay, is going to show its balance sheet, if it's going to do a buyback, it is going to do, to sell, it's going to borrow. They have to do that, and they're not doing something wrong, mind you. I mean, I'm not gonna sit here and allege that they're doing all of this in a bad way. But let's say a company wants to buy back $1 billion worth of its own shares. They will try to buy it at the least possible price because they try to buy back as much shares as they want. If a company wants to borrow some money because they need cash, they are not going to announce to the world that we are in hardship for money, we need some cash. This means we'll make two things. Either we'll make the cash expensive or we'll bring the price of their stock down. Okay? There has to be some discretion and some confidentiality, if you will, when you're disseminating knowledge, and a timing of getting this knowledge out. Now, having this lag time, if there is, let's say, let's say they're trying to buy something at day 1, and they're going to give the information out on day 30, there is 30 days here that we do not have the information, and we can see that the prices are going up and down. So we cannot solely depend on the fundamental information because there is a big lag time between the time it comes out and the time we're able to use it. There is a myth out there which means that if you are going to be a successful trader, you should be a good analyst. No, sir. That is not the case. That is a myth. Being a good analyst does not guarantee you become a good or a successful trader. You can become an expert analyst, but unfortunately, you would not be a successful trader. Okay? In most instances, it is the other way around. If you are successful trader, the odds are you will become a successful analyst. If you are going to be an analyst by yourself and want to pay your own bills, and I'm not saying this in any way to discredit any analyst, but if you are going to pay your own bills, being an analyst is not the way. And the reason is, this is, again, it is nothing against analysts, forgive me, it's nothing against analysts, but this is a key ingredient in this approach that we are going to use. And that key approach is trade what you see on the chart. Do not trade what you think. Because my opinion, if I think that the see if they still hear. See if they still hear me. Can you ask them, because I turned off the mic here? Can they still hear me? If I think, for example, if I had in my head that the dollar should be going up, I will give you if I said in my opinion that the dollar is going up, and I have in my bank $100 million. If I have in my bank $100 million, the dollar market is an $11 trillion market. Now, do they hear an echo now? Can they hear an echo clear now? Is it okay now? So if I have $100 million in my account, and this is an $11 trillion market, and I decide that the dollar should be going up, and I'm going to buy $100 million worth of dollars. That's all my opinion is worth. $100 million in an $11 trillion market, which is basically nothing. I doubt if any of us has $100 million here to bet on one trade. So if I'm betting $10,000 on a 10 lot, or I'm spending $100,000 on 100 lots in an $11 trillion market, that's how important my opinion is. If somebody else has twice as much cash than what I have, he has twice as much power in that market to influence the market than I am. I could be right, he could be wrong, he wouldn't know what he's doing, but the sad aspect is he has enough cash to make a bigger mistake and make a fool of himself, and that person will cost me my money. So and at the end of the day, you will say that this guy is wrong, this should not happen, the dollar should be going up, but you see the dollar coming down, and if you're going to maintain that idea that I am right and this thing should turn around, we will end up losing money. So the key here is we trade what we see, we do not trade what we think. So we're going to examine first the fundamental data, and then we're going to go into the technical part. Now, we are going to, could you time me, so every 50 minutes we get out? So we started at what? At 50 past 9, stop me, so we take a 10-minute break. Okay, 9:50. All right? So we're going to examine the fundamentals analysis is basically the examination of all the economic forces that will affect the well-being of the economy as a whole. Okay? And we're going to look at the financial data, and we're going to use this financial data to forecast the future value of the instrument. And when I say instrument, it could be the US dollar, it could be the Japanese yen, it could be Apple, it could be AIG, it could be Goldman Sachs, it could be Bear Stearns, it could be anything. That instrument that I am looking at, I'm going to take the financial data so that I can forecast a future value. Now, this is how we think. This is the way now that we have to think and how to apply the thought. And I'm going to show you. And this is that way of thinking. You apply it to stocks, you apply it to foreign exchange, you apply it to commodities, you apply it to the stock market. It is It is a way of thinking. We get this, what's known as the funnel approach. And the first thing you look at, you want to take a look at the global economies. You want to sit and ask yourself, what is happening in the world? What is happening right now? And you define what's happening. Why do you have a mic? I'm recording. Okay, now if you want to put the mic back. No, you're making an echo unnecessary, and I'm getting disrupted, so that's it. Just take it out. As long as it's being recorded from. Thanks, David. So now we have to look at the economic market, the global market as a whole, looking at the global economies. I want to see what's happening in the world today. I want to see what's happening in the United States. I want to see what's happening in Europe. I want to see what's happening in the Eurozone, let's call it this way. I want to see what's happening in the UK. I want to see what's happening in Africa. I want to see what's happening in the emerging markets, South America. I want to see what's happening in India, China, in Tokyo, in Japan. I want to see what's happening in all those markets. I want to look at those markets individually to see what these markets are and what's happening in there. I want to look also at interest rates, which is the interest rate differential between one currency and the other. And then I come down and funnel it down to a final pair that I want to go into a certain direction. Whenever, this is a little bit dedicated towards foreign exchange, but again, it is important to keep in mind. Whenever we're looking at foreign exchange, these are the basic components that affect foreign exchange. One is the general economy, let's say the US economy, the British economy, the whichever economy you're looking at. Then you're looking at what's known as capital flows and trade flows. Capital flow and trade flow. And then you're looking at interest rate differentials, or the difference between the interest rate that each country is paying for its currency. So how much is the UK paying here if you borrow money? 5%. How much is Japan paying? 0.5%. So if you have now $1 million you want to put on deposit, and you have the Bank of Japan here, and you have a Bank of Somomoto, whatever, here in Edgewood Road, and you have Barclays, and Barclays is paying 5%, and Sumomoto Bank is paying 0.5%. And you're coming in with a briefcase with $1 million. Where will you put the money? Where will you put the money? In Sumomoto, right? And the Barclays Bank, that Barclays Bank is paying 5%. All right? So I'm looking at the interest rate differential, because this is what makes people put the money, place the money in whichever economy. And then we're looking at the GDP, and then we're looking at the correlations between the markets. Correlations is a very big thing. We'll get to it in a second. So whenever we think about foreign exchange or currency, you have to think these are the only 4 components that you have to take in. If an event is taking place, these are the first 4 things that should come to your head. Capital flow, and how would this event affect capital flow? How will it affect the trade flow? How is the interest rate is playing in this case? And the last but not least, it's a very important point, is risk appetite or the risk aversion. This is a very important key. So we'll go through them one by one. Now, one point I just want to make sure that is I bring is that economies either they grow or expand, or they come down or decline in trends. it takes great deal of time for an economy to change its direction. If an economy is moving and it's growing and there is growth and employment is being, and the prices of the shares are increasing and everything is strengthening, then this trend, this upward trend will continue for a while. If things are bad, then this downtrend will continue for a while. We need to look at evidence that the trend is changing, not based on one single report or two single reports. We're looking for continuity. So in the United States, they will tell you that the weekly unemployment this week was down 100,000. So there is only 250,000 people filed for unemployment. Is this good or bad? Is this good or bad? Right. But in the scope of things, is this good or bad? It's nothing. It's just one day. It's not a change. It is just one day. This economy has been taking down, losing jobs all the way down. If we had one blimp up like this, that's all what it is. It is one news report that came out that said that there might be, if I want to know that there is really a change in the economy, I am looking for continuity. I want to see that this month was now, let's say, if the average is 350,000 people filed for unemployment every month, so I want the first month to be 300,000 people filed. I want the following month to be 275,000, and then 250,000, and I want 225, and I want 200, and I want 180. I want this continuity of decline for 6 or 7 months to tell me that the economy has changed. This by itself means nothing. This is just one number that does not indicate that the trend is changing. Okay? In the economies, we're looking for what is strength and weakness in the economy, and therefore in the business environment. We're trying to find out, is the economy growing or declining? We're trying to see, is the economic trend, like I was showing you here, increasing or decreasing? Is the business environment improving? This means that people are getting hired, people are able to sell more, people are buying, the housing is getting better, the home builders are getting better. And then we're going to look at the announcement that is coming out about the employment or the unemployment, and we're going to see if it's going to change our perception. And we're going to see that these events give us a short-term trading opportunity. Let me do a little bit with TradeStation here. I want to show you, okay, what do you see now on your charts? All of it? Okay, so let me fix that a little bit. I want to go through this. How is it showing now? Just give it. You have this chart? Okay. All right. So let's put up a chart here, and okay. Let's do a little bit of thinking before we pick a chart. I will do a little bit of history, something that happened a few years ago. And I'll show you how we do this funnel kind of thinking. We look at the global market, and then we look at the sector, and then come down to the individual. And then we're going to use the present time. So let's go back to the classic, which is 2003. What happened in 2003? I'm sure. War. Yeah, that's. So we had the war started at 2003, right? So what happens in wars? We spend a lot of money on defense. So if there is a war, then the first thing there would be planning for war. So people will be planning for war. That's the first. Then, after that, there will be defense. Spending a lot of money on defense because we need to have planes, we need to have bombs, we need to have ships that move these bombs. Okay? We need to take all those weapons to the area. And then, when we get there and the war starts, we have what's known as the destruction, if you will. Okay? Are you with me there? So if there is a war that is being planned to start, and we know for a fact that it started at March 12, so before that there was a little bit of planning. After March 12th, the war began to take action, and the planes were taking the bombs, delivering the bombs, and they began to flatten the area. So once they start flattening the area, what is the next step that should take place? Reconstruction. So after we flatten that, after we do the destruction part, we do the reconstruction. We rebuild. Okay? And after we rebuild, what's the next step? Another one. Huh? We build this company, we get the infrastructure in, the hospitals, the power plants, and all of that stuff. Now, so I call it infrastructure. Okay, so let's take it step by step. And would you like to do that example in foreign exchange, or you want to do that in stocks? Huh? Foreign exchange. All right. We'll do it in both. We'll do it in both. So in the planning process, when the things are being planned and going into, okay, let's get to here. Now, in the planning, they are basically shipping, taking the tanks, the soldiers, and the weapons, and all of that, and putting them at the location of war. So which companies, let's say, would be benefiting in this area, in this time? So as of before March in 2003, which would be the companies, or which sector would be, I would let you call the shipping sector. So the ones that have ships that are going to hire, they are going to be hired, chartered to ship, to carry the goods and armies to where the location is. And also in that time, in the part of the preparation, they are buying planes, warplanes. They are also buying bombs and whatever, rifles, guns, and all the defense part. So you're looking at the companies that produce planes. You're looking at the companies that produce weapons. Huh? Medical services. Well, okay, but the company that manages all that, you're 100%. You're looking for the company that manages the food, the supplies to these armies. Perfect. Okay. let's so I don't go through many pages. So which would be the primary candidate in this case in the defense sector that produces planes and rockets and stuff like that? Which one do you think? Which company is that? First company that comes to your head. Boeing. Yeah, Boeing is the biggest aircraft corporation. So let me put a chart for Boeing here. And I want you to look at this. This here this is 2003. This is April 2003. So in April 2003, right there, somewhere around there, the war started. Let me see what the date of the war started, which is, I think, March 12. Okay. The beginning of the war, where I have the ellipse right there, that was Boeing was trading at about, I would say, $25 a share. Once the war started, and that's an economic event that's happening in the world. It is a way of thinking, guys. I want you always to think of taking what's happening, which is going to benefit, which is not going to benefit, and then you zoom in to find the crust or the one that's going to have the biggest impact, and this is the one we take. So if I have Boeing now, that is going to be the biggest defense contractor, and they are the ones that deliver bombs, rockets, satellites, and all that lovely stuff, and it's trading at $25, and then the war begins, then the first thing I need to do is to start buying this company. And if you buy it at $25 in 2003, now, as long as the war has been going, whether it was going good or bad, but there was usage and needs for weapons because the war did not end, then Boeing keeps on going up. Once things decline and slow down, then it begins to change. Okay, I want you to keep an eye on this ellipse that I have here and this area of 2003. What other companies that are in the defense? Okay, Lockheed Martin. And again, gentlemen, that is your March 2003. Lockheed Martin Boeing was $25. It went all the way up to $100. So if you bought Boeing at $25, 1,000 shares for $25,000 in 2003, in 2007, when it peaked, in 4 years, that $25,000 would have multiplied 4 times, and it was worth $100,000. This is Lockheed Martin. If you would have bought it at 50, it went all the way up to 115. That baby doubled in value. Okay? It's the same thing. What else? What other company? I want you to look at, again, the area of the 2003 where I have the ellipse right there. Because all of these sectors are working together. Look at Northrop Grumman. Okay. NOC. Look at, that is your NOC. It was a $35 stock or a $45 stock. It went all the way up to $85 stock. Raytheon, what's the symbol of Raytheon? RTY? RTN? Oscar, what's the symbol of Raytheon? RTN, I think. Raytheon, yeah. Okay. Here is Raytheon. Raytheon in 2003 was a $28 stock. It went all the way to $70, 300% on your money. Okay? All right. These are the companies of destruction, if you will, or the bringing the defense companies. Look at. Unfortunately, this didn't start. But anyway, okay. Now, what if we're going here? We said that the first one is the planes and the weapons and the destruction. It's okay. After the destruction and the leveling down of the ground, what would be the next sector of the economy that will come in and begin to benefit? Now there is no more use for bombs, no more use really for planes. There is no. What would be the next sector that this of the economy that would be needed after the war after the aggression, whatever you want to call it, is done? Building. Okay, we're going to get into the building and construction. But think now that you have a building that has been completely demolished, and now you want to build a new building. What's the first stage that you have to do? Clear it out. The earth-moving equipment. What is the biggest earth-moving equipment? Huh? Caterpillar. Yeah, I mean, good. All right. So going at Caterpillar, and look at the law of 2003. That's the law of 2003. There's your Caterpillar in 2003, right after the war. And once things are settled down, at the end of 2003, it was a $28 stock. This is I don't know why is it doing so slowly. I mean, just imagine when you see that there is a war going on, and then you begin to have something like this. This is the beginning of that was July and of 2003, because they said it's going to be a cake war. It's going to take 6 weeks, or I mean, worst case scenario is going to take 6 months. So technically, beginning of July and August, after 4 months or so, they're beginning to buy the earth-moving equipment, and there you have your big trend to the upside, the big momentum to the upside, and it keeps on. Now, Derek, you were telling me that there will also another company that would require, food and medical services and stuff like that. Which company do you think? The name of a company, if you know. Huh? Halliburton. They are the ones that were responsible for the food, the drink, and the medical supplies. So let me put Halliburton for you. This is the classic. Halliburton is the classic. Okay? I mean, that's it. And you have to follow Dickie Boy. Dickie Boy is a genius. You look at this. In 2003, Halliburton was $10. $10. As soon as the war started and they got the... so if you were 1,000 shares of Halliburton for $10,000 in March 2003... Hold on a second now. I want you to see the rise and the glory of the price chart. It's lovely. I mean, because this, remember, and this goes back to what I was telling you, Charlie, a little while back, that we have to trade what we see, not what we think. Because if I thought that there is a war going on, why would I buy Halliburton? I mean, why would I go and put my money into this? And if you had, for some reason, any opinion, whatever, about not buying Halliburton because it was $10, it was on the verge of bankruptcy. Mind you, it was on the verge of bankruptcy. They had nothing to do. There was nothing. And suddenly, this thing begins to move up, and you do have a little component that gets into the equation of nothing, something trifle like a war, and the vice president's the chairman of this company. I mean, there's nothing more. There's nothing more. I mean, these are, and look at this. Look at this rise. From $10 to $55. 500%. 100% a year. And this is all by just this way of thinking, identifying what. Okay, let's do one more. In a war like this, we're going to go now into the currencies to see how we can apply that into currencies. If there is a war, what do normal people feel? How do they feel? Scared. And if I'm scared, and if I'm scared on my capital, what would I do with my capital, Charlie? If I'm scared about my capital, what would I do with it? Put it into gold. That's a good. So let's see if that. I mean, keep in mind now we have a war. One of the major components of war is that there is fear, uncertainty. People are scared, right? So let's put a stock for gold. And again, keep in mind we're looking at the. No, this is the new one. Look at this. The price of gold in 2003 was about let's say $480. So if you bought an ounce of gold at $480 somewhere in the beginning of 2003, the longer the war stays, that baby goes. Yeah, that's the futures record. You want the cash? That's the continuous cash contract. Okay? So you would have bought it at around 478. It went all the way up to $1,100 an ounce. Okay. So you would buy it again. All this stuff happened is that we have now developed a way of thinking, which is the funnel way of thinking. What's happening in the world, what happens into that particular market, and then in that particular market, which sector of this market is going to be affected, and in what sequence. We have, as you see here, I took first the planning part, then the defense, then the destruction, then the reconstruction, then the infrastructure. We have to think of that sequence so that we can time ourselves into the instrument that we are going to invest in. Okay. When the war started, what part of the world did it start in? Middle East. What is the Middle East known for? Oil. So if there is war in an oil zone, what would you expect to happen to the price of oil? To increase. So it would be a good thing for us, if I had the access, is to buy oil or oil companies, futures. Let's take the oil companies for it's making it easy. Again, I want you to keep an eye on '03. This is ExxonMobil, ladies and gentlemen. In 2003, ExxonMobil was a measly $35 a company. Was $35 as soon as the war started, and people were scared about oil. That's the end of 2002, 2003. It just moved and it never looked back. From $35 all the way up. Oh, it's still going up, it's still going up, still going up. Went up to 100 and some odd dollars. From $35 to $100 in, and it's not just ExxonMobil, look at BP Petroleum. The same thing, look at there. That's the move. That's from 2003. That's your move. All the way from $35 to all the way to 70. If you want to look at the crude oil itself, that's the price of oil itself. From 2003, oil was around $40. It went all the way up to $140 a barrel. Okay? Now, let's take a 5-minute break. It's not 9:50, people are standing up. Okay, so let's take a 10-minute break. If you want to get a cup of coffee, and then we'll come and finish this, and then we'll take it into the foreign exchange. Hmm?